Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Kansas City and Minneapolis wheat markets. I'll start with Kansas City wheat. The low water mark of the 18th of August was pivotal to the construction of what happened next. Back then, the market failed to break down through the neckline, currently at 823, and highlighted in red on my daily chart of the small but influential October 2021 to January 2022 head and shoulders top. The market chose instead to construct a new pattern, a bullish one. This was easy to do once prices overcame the short medium moving average. Remember this moving average, as it will pop up again later. There was a small free zone above at the time, all the way up to the July 2012 high at 957. When the market reached the 957 area, I thought there might be issues. You see, 957 is the gateway to a congestion area above that, between 957 to 1001, within which prices rose up, pushing over the now flatlining long moving average, currently at 1009. Additionally, a lot of this congestion was old and made up from 2011 and 2012 and was easily breached on the way up in February, on the way down in June. However, back in those days, the construction did not have the additional reinforcement of the long moving average in its midst, and it is this reinforcement along with the upper bull channel line that constrained the market in early October. In the process, the market took on a new shape, primarily caused by the weekly key reversal down made that same week. In fact, it's hard to judge if the shape made the weekly key reversal down or vice versa. Anyway, at the end of that week, the market broke down through the lower bull channel line and also dropped out of the overhead resistance area and even started moving below the now flatlining medium moving average for a while, currently at 916. Then, along came the very early November action, or as I refer to it, a week of time wasting, but also a week of defining industry. This is a parallel of what we saw in Chicago wheat futures. I'll expand on that shortly, but first I'd like to look at part of my commentary from 3 weeks ago that is seemingly still valid, and I quote, "Much like Chicago wheat, though it's not a complete duplicate, the market has two avenues, though there will no doubt be more available eventually. First is a straightforward move down with potential targets for the break of the bull channel. Thus we have a primary target X down in the 903 zone, whilst a secondary harder to reach target X1 is way down below in the 759 zone. This leads to the second avenue. It's a possibility for the whole of the July to day action being not just a flat bottom, but a flat bottom with an extension. Extensions have something like a bull flag with them usually, and this may have been what was being tried to be built here ever since mid-August. Personally, it looks a little slack as a pattern, and is an untested but if the short medium moving average, currently 945, manages to hold the market up, and I will add this week the target X at 903 to that list, if even manages to hold up the market and we then see prices revert back up, well, then the second scenario, the larger bottom with an extension, suddenly looks a lot more interesting, and that's the end of the quote. Last week, the bearish pressuring of the market finally started to show results with a significant dip below the medium moving average, all the way down to the 50% Fibonacci line of the August 2020 to May 2021 move at 900 and a quarter, thus finally reaching target X at 903. Instead of going passively sideways, this market this week has seen further bearish pressure as prices finally broke down through the medium moving average and started to tackle the July to September congestion below between 831 to 900. Initially, the market was held up by a second Fibonacci line at 881 for the September 2019 to May 2022 move, but today it seems the floodgates were opened and prices punched down through there and the 2013 high at 862. We now have some congestion below from the 2014 high at 855, but there isn't that much now below. It all depends whether the market can exploit this breach. I have to say right now, target X1 at 759 is looking attractive. It will depend, should prices choose to move lower, what they will do at the red neckline, currently at 824, which I've previously mentioned. Remember, the market was held up by this simple looking support back in August. Minneapolis wheat. Over July and August, we've seen a slightly boring market compared to the earlier summer, a sideways to lower channeling market. In early September, there was a start of another bullish pattern. It seems to have been prompted by the approach at a steep angle from above of the short medium moving average, currently at 964. And rather than this moving average acting as a cap on any rise, it instead acted as a trigger for a move higher. Now remember this moving average, it will show up again later. This move higher seems to have been slower than in the other grain markets, which is a nice segue into the bull channel come ascending, expanding wedge pattern formed until early October. And the one I have highlighted in blue on my daily chart. Now, I'd previously called this construction rudimentary, not only because it was then rudimentary, but also because the market is, as I've often said before, was way behind both Chicago and Kansas City in its construction. Now, you only need to look back at the continuing flatlining long moving average, currently at 1037, and now flatlining medium moving average, currently 941, to see this. Incidentally, this medium moving average seems to have triggered the move, well, limited move lower, seen in early October. Just look at the relative positions of these moving averages compared to the same moving averages in other grain markets to appreciate how shall I put it, how inferior the actions have been here compared to the other markets. Anyway, as I said in early October, the market broke down through the lower trend line of the bull channel come ascending, expanding wedge pattern. This now leads us to the same two avenues that I can see here as well as in Chicago and Kansas City, though there will sure be eventually more scenarios available. The first is a straightforward move down with potential targets for the break below the bull channel come ascending, expanding wedge pattern. Thus we have a primary target X on the downside quite a way lower compared to the other grain markets. That's in the 883 zone, whilst a secondary harder to reach target X1 is down in the 840 zone. This leads to the second avenue. It is a possibility for the whole of July today action to be a sort of bottoming action, but with an extension. Though to be honest, this one is really looking like it doesn't have an extension here at all. However, as I said 4 weeks ago, and I quote, "Here is the key. If the previously mentioned short medium moving average acted as support as recently as yesterday," so this back a few weeks ago, or even the 50% Fibonacci on the August 2020 to May 2022 move at 955, if they do manage to hold the market up, then we may, just may, see the opportunity for prices to revert back up. Then the second scenario, the larger rounded bottom with an extension, suddenly looks a lot more interesting. End of quote. Recently, the current situation saw the market on the borderline of not happening at all. But gradually, the bearish incentive asserted itself as 2 weeks ago the market closed below the short medium moving average. Last week below the 50% Fibonacci line, and this week below the medium moving average. The market is seemingly in a fairly free zone now down to target X, but if you look at the action in July and August and early September, you'll see a congestion band roughly between 940 down to target X at 883, possibly as far as the 2017 high at 868. This is what the market is now working its way through, and it seems to be incentivized to do so. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.